Before you finish your morning coffee, an automated underwriting system may have already determined whether your business qualifies for capital or gets screened out before a human ever even sees your file. Not a loan officer or committee either. This is an automated AI-based underwriting engine at pretty much every financial institution nowadays. This applies primarily to SBA 7A loans, SBA Express, and conventional bank term loans and lines. Also, applicable fintech lenders use these same sort of automated systems, only in a different way. These are core sources of institutional and private funding for small businesses. This video is educational, not individual financial advice, and lender standards do vary from lender to lender. If you'd like individual financial advice, that's what my team and I do all day long. We help people get business loans and lines of credit. Feel free to inquire with us by heading to the description. Most owners never see this automated system at all. They apply, receive a generic denial, and assume the problem is timing, the economy, or just bad luck. In reality, the decision was made upstream based on how their numbers look and how their numbers fit into a risk model. It's crazy. I've spent years working directly with SBA lenders, bank credit teams, MCA underwriters, and fintech underwriters, helping business owners structure funding files that ultimately get approved for the cheapest money possible. I've also seen strong businesses denied for fixable reasons, and it stinks because a lot of them don't even know that those reasons are fixable, including some businesses that I initially even underestimated myself until we dug in. Once you understand how underwriting systems evaluate risk, outcomes stop feeling random and they start becoming far more consistent and predictable. Today, I'm going to show you how underwriting actually works in 2026, where most businesses fail, and what you can do to position your company to pass before you ever even apply. Modern lending is no longer relationship driven at the front end. Most banks, SBA lenders, and fintech lenders now rely on automated underwriting models to screen applications before a human even gets involved. This allows them to have less employees, less overhead, while also processing the same amount of applications. These systems are designed to apply rules consistently and eliminate discretion early on in the process. They don't evaluate effort, character, or vision. They evaluate patterns, ratios, and probabilities, and you need to know that before going in to apply. Relationship-based exceptions still exist, but they're far rarer than most owners believe, and they require exceptionally clean files nowadays. No falling off in revenue, not even a bad month, not even a bad quarter. Different lenders apply these rules with different tolerance levels, but the inputs they evaluate are largely similar. Banks evaluate tax returns, fintech companies evaluate bank statements. If your file fails the automated screen, it's either declined outright or pushed into a manual review where standards become stricter, not more flexible. And that's only if you have a broker that has a relationship with the lender and tells them to overturn the decline. That's where preparation matters more than persuasion. So here's step one, your scoring profile. The first filter most systems apply is your small business scoring service score, commonly called the SBSS. This is especially true of SBA loans. As we move into 2026, all lenders are looking for roughly 165 or higher SBSS score just to advance past automated screening for SBA loans and bank loans. This score blends business data with personal credit behavior, so it's business credit and personal credit combined. And personal credit still absolutely carries meaningful weight, especially when applying for bank or SBA loans. From an underwriting perspective, personal credit remains one of the strongest predictors of repayment. Don't forget that. If your business has multiple owners with 20% or more equity, each owner is evaluated. Every owner that has 20% or more in equity. And this is a common failure point, and a point that a lot of people don't understand. If one owner's credit profile is materially weaker, the system often defaults to the lowest qualifying score as the effective risk rating for the entire business. They also sometimes blend the highest score with the lowest score and come to a score in the middle where that's the score that they evaluate the entire business on. This doesn't automatically kill a deal, but it raises the bar everywhere else. Fail this stage and nothing further in the application is considered with that specific lender. But you can always rework the ownership, then reapply, and then rework the ownership again. Or you can always get that owner into a credit restoration program and help them to work on their personal credit score so that they can help the company qualify for the loan. Step 2, cash flow and debt capacity, DSCR. Next, underwriting evaluates whether your business can actually support the additional debt. This is measured using a debt service coverage ratio, or DSCR. Fintech underwriters are looking at average daily balances, numbers of deposits, whereas bank and SBA underwriters are looking at tax returns and profitability usually. In simple terms, lenders want to see that for every dollar of loan payment, your business generates at least $1.25 in profit before interest and taxes. Here's an example of a very common scenario. A service business that's growing is generating just $500,000 in annual revenue. On paper, it looks relatively healthy, growing small business, right? But after expenses, because again, it is growing and investing back into itself, its cash flow only covers existing obligations. The business survives, but it has no margin on paper, no profitability. The question is not generally, are you profitable? The question is, do you have margin to cover the debt? To an underwriting model, that business is fragile. With prime rates around 6.75%, lenders now run stress tests on cash flow and net profitability. They evaluate whether the business could still meet their obligations if their borrowing costs rise or revenue softens a little bit. So they're just looking out for their own necks, just like anybody would. If cash flow lacks resilience, the file is removed from consideration automatically. This isn't punishment, it's risk control for the banks. Step 3, your bank account behavior. This is where many otherwise solid businesses get tripped up. Automated systems, especially in the fintech sector, they now analyze 3 to 6 months of business checking account bank statements, transaction by transaction. This review is behavioral for your business. It's not personal. We don't care about how many DoorDash orders you got. Overdrafts and insufficient funds fees are among the strongest negative signals to lenders. Even 1 or 2 can materially increase perceived default risk. Very small and low average daily balances carry a higher risk rating as well. Large irregular deposits are also scrutinized. If more than 40% of monthly revenue appears in a single deposit, the lender will require documentation to confirm the source of that income. That's because if that one deposit goes away, that's 40% of your revenue. Funds generally must be seasoned for at least 60 days to be considered stable operating capital for banks and SBA lenders. And fintech companies look to see that they're recurring for at least a couple of months as well. Recurring payments to individuals are also analyzed in your business bank statements. If obligations appear that were not disclosed initially, they may reclassify it as undisclosed debt. So watch out for the little things. The system isn't looking for perfection though, it's looking for some sort of predictability. It's just looking to make sure that they're not gonna throw their money away. Step 4, industry and location risk. Underwriting also incorporates the external data at a lot of lenders. Your industry, geographic market, and historical default rates for that industry and geographic market influence how conservative the system becomes. For example, restaurants and retail, as well as other high failure industries, are not excluded at all, but they are underwritten by banks and SBA lenders a little bit more tightly. These businesses must be cleaner, better documented, and they need to be more conservative than average to pass. Lower risk industries such as professional services or healthcare face fewer statistical headwinds, but still must meet the same core financial thresholds. The system evaluates probability, not potential. They don't care about what your credit used to be or what your profit is going to be. Once you understand that, the preparation becomes strategic instead of emotional. This process applies to established businesses, not ideas. Keep that in mind as well. If your business is pre-revenue, informal, or still a side project, these standards will apply to you later, not yet. So kudos on you for being proactive, and stay subscribed to my channel in case anything changes. For businesses with real revenue, real expenses, real investments, and ambitions, the rules are already in effect whether you understand them or not. None of this is hard, but it does require discipline and honesty with your numbers. Precision and knowing the rules now matters way more than storytelling, because everything is done by machines. Here's a couple more things to note. All owners and key managers that have 20% or more of the business must be US citizens or permanent residents with green cards in order to get that SBA loan, typically with at least 2 years of status history. But there are still fintech lenders that will approve you based on revenue if you have a visa. Every dollar of requested capital must have a clearly documented use tied to growth or stabilization of some sorts. The SBA and bank lenders are going to make you fill out a use of funds document or break it down number by number for the amount that you're requesting and moving forward with them. Certain sectors, such as domestic manufacturing, are currently benefiting from targeted incentives, so they may not have to do a detailed use of funds. They could just put a large amount towards working capital. Most businesses, however, right now must fully plan for the total cost of capital. The good news is this: most businesses can materially improve their underwriting profile in 60 to 120 days once they know exactly what to fix. And people don't realize that you can turn over a denial to an approval within that short of a time period, but you can. Even if you've been denied before, the system doesn't remember intent. It only evaluates your current profile right now. Every month you delay cleanup is another month the system reads the same weaknesses and holds you back. You don't have to guess how the system is going to view you either. Below this video is a link to schedule a strategy session with my team. We do this every single week, every single day for owners that are preparing for SBA and bank funding. You'll leave this call with one of 3 outcomes. Either you're ready now, or your profile needs cleanup and the foundation just needs a little tweaking. And third, you may need a little bit more time. You'll see exactly where you're strong, where you're exposed, and what to fix before you apply anywhere. We can help at any stage, but it's vital to know where you're at so you can have a game plan at least and move forward to be proactive. Most owners come to us thinking that they're failing because they've been declined by 3 different banks, when in reality, they're simply unprepared for how the system works and their loan application got declined before it even saw a human's desk. The reality is capital is still available more than ever, but it flows to businesses that understand the rules of the system making the decision at underwriting. If you want to pass the test, preparation isn't optional anymore. It's the advantage that you need.